All right, we're going to talk about section 13.5, which is talking about some financial investments that you can make when you've got that money available. And the two that we're going to talk about are just stocks and bonds. If you look in the chapter, there's quite a bit of other information, but we're just going to look at these two. We're going to be talking about with stocks. What a stock is when you buy a stock, you're actually buying a little piece of the company, a little share in the company. And the company will pay you a little bit of the profit that they make, and this is called a dividend. So if the money that you're making is more than what you paid, then it's called a gain, a capital gain. But if you lose money on the stock, then it's called a capital loss. So hopefully with stocks, you usually are increasing your investment or by a little bit each month or a little bit each period of time. So it's a good thing. So what we look at is we look at the return on the investment, and that's the difference between what you received and what you paid, plus any other expenses that you might have to worry about, such as paying a broker fee or something like that. So a lot of times these stocks are set. You don't have a whole lot of control over it, and the stock exchanges are where the stocks are sold and bought. And so let's look at this. If you buy 100 shares of stock in Company X on February 2nd, and you pay $28.50 per share, a year later you get a dividend of 60 cents per share, and the stock has risen to $29.75 per share. So the first thing we want to know is how much is the total amount of cost for that stock. In other words, how much did you pay for the stock? So you paid $28.50 for 100 stocks. So it's multiplied by 100. So that means you paid $2,850 for your stock. So at the end of a year, you haven't sold your stock, so you don't have any money back yet, except for the dividend. So how much dividend did you get? You got 60 cents for each share, so for 100 shares. So you got a check for $60. Now, if I were to sell the stock right now, what's the capital gain for the stock? If I sold the stock right now, I would be selling it at $29.75 a piece. So $29.75 times 100 is $2,975. So the $2,975 minus the $2,850 tells me that I would have gained $185 per stock. I mean, $185 total. Okay, and that's what we call the capital gain. That's how much money I made. So the total return would be $125, which is the gain so far, plus, oops, I wrote down something wrong. Sorry. This isn't $185, this is $125. So $28.50 would be $125 gain. Sorry. Okay, so how much is the total return? It's the $125 plus the $60, and that's $185. So what's the percentage of the return? That's the $185 divided by what I started with, which is $28.50 times 100, just to make it a percentage. It would be 6.5%. Okay, so let's look at it again. I spent $2,850 on the stock in 2006. In 2007, I got a $60 dividend. Okay, so I hadn't sold it yet, but I got $60 back. The stock is now worth $2,975, which means I made $125 if I were to sell it today. But I also got paid a dividend of $60, so that means that I actually will make $185 on my stock. So then they want to know what percentage did I get back. It's 185 over the 2850, which is 6.5%. And that's what these calculations are telling you again. Okay. Now, in your book, there is a table, and the table is on page page 726 in your book, and it's going to be on another slide. You'll see that. But what I wanted to do is explain to you some of the different parts of this table. In the table, you'll see, the first thing you'll see is usually the name of the stock and an abbreviation for the stock. One of the categories you'll see here is a year-to-date percentage change, and that just tells you what percentage it's increased this calendar year, increased or decreased. Okay? Then there's going to be another column that talks about the 52-week high and the 52-week low, and that's, again, basically what's the highest value for that year and what's the lowest value for that year. And then what you're going to see are these yield numbers. There's going to be the dividend yield, which is how much the stock is paying for the dividend, that annual amount. The 2.8 is the percentage of yield, and the 35 is the price earning ratio, which is basically the stock price divided by the earnings per year. There's another number that you're going to see here called the VOL, the volume, and that basically is telling you how many shares were sold that day. And that number in this case is per 100, so it's going to be 100. If you're going to add 2 zeros on the end here, so it's 141,100. The close is going to be the amount that it closed at that day, and the net change is going to be how much it was higher than the previous day or lower than the previous day. So those will be positives or negatives. So some of the other things that you might see is that you might see a line of this chart listed in bold, which means that the price changed more than 5%. You could also see a row underlined, which means that it's a stock with a very high volume of trading for the day. You could also see that abbreviation of PF, which means that it's a preferred stock. And basically a preferred stock is a stock that is sold to certain people, and it has better returns and more guaranteed returns than the regular stocks. And then we have the symbols next to the 52-week high and low, which indicates whether it's a new value. So if you see the up arrow, then you're talking about it's a new 52-week high, or if you see the down arrow, then you'll see it's a new 52-week low. So again, here's the table that we're looking at, and I want to go to this table, and we're going to look at some of the examples that you're going to be doing for this. So this is a copy of the table that is available for you to print out. So if I wanted to know what is the closing price for CarMax, the closing price for CarMax. So you're going to find CarMax in your list. Here's CarMax. And the closing price is right here. So the closing price for CarMax would be $20.93. Okay, what if I wanted the 52-week high for Pearson? The 52-week high for Pearson. So here's Pearson. And up here at the top, you'll notice 52-week high, 52-week low. So 52-week high is $16.37. So it's $16.37. Here's another one. The percentage, the year-to-date percentage of change for Yum Brands. So here's Yum Brands. Now here's a percentage of change, right? But then here's a percentage of change for year to date. So you have to pay attention. They want the year to date percentage of change. So it's 16.84. So it would be 16.84% higher. And I know it's higher because it's a positive number. This one, for example, is 5% lower. Okay, so my last example was, let's say I wanted to buy 100 shares of Sara Lee using the closing cost for the day. So Sara Lee, here's our closing cost for the day, and I want to buy 100 shares. So I'm going to do 1424 times 100. So I'm going to have to pay $1,424 for 100 shares of Sara Lee. Now that's assuming right now that there's no broker's fee or anything like that that I'm dealing with. Okay, so let's talk about the broker's fee. So when you have brokers, these are the people that are actually selling the stock to you or providing the stock. And we have full service brokers, which are basically people who are going to go out and do all the research and keep up with the information and make sure that it's a good deal. And then we have discount brokers, which are basically people that'll just buy the stock for you or sell the stock for you based on what you're asking them for. They won't necessarily go out and do research or tell you different things. And when you're paying the broker's fee, you're paying their commission to do this work for you. So the commissions are usually some sort of percentage of the principal or percentage of the amount that you're borrowing. And the rates are going to depend on how many you're buying, whether you bought an odd number of things, an odd lot differential. These are different terms that you'll see. Um, Sometimes the brokers will place a limit on you. They say, well, we won't deal with you unless you're going to buy at least 5 or 6 or 100 stocks. Um, it's just something that's not worth their time and effort if you're just trying to buy 2 or 3 stocks. So some of the different possibilities for commissions, this is what we call a broker-assisted trade. And you'll notice that in this situation, there's a flat commission and then a percentage of the amount that you're investing. So it's a tiered situation where, up to $2,500, basically you're paying 1.7%, you're paying a higher percentage rate, and the more money that you're investing, the lower the amount of um, the commission that you have to pay. And then there's another case where they'll just say, how many shares are you buying? And we're going to charge you a flat fee or a certain amount based on the share. So up to 1,000, you're going to pay $29.95 flat fee, even if you're only buying 1 or 2. And then more than 1,000, you're going to pay 3 cents per share. All right, so here we have an example. Find the total cost for the broker-assisted purchase of 800 shares of stock at $5.45 per share. And I want you to use the information from the 2 slides. So if we have the basic cost, then we're going to have to take the $5.45 per share times 800 shares is going to equal $4,360. So this is the amount that we want to invest. This is the principal, this is the cost. Okay, so that's our principal amount. So the commission, if you look at your chart, the commission for this for $4,360 is $65 plus $0.66% of the principal. So I'm going to take the 4,360 and I'm going to multiply it by 0.0066, which is 0.66 divided by 100. And that's going to tell us the amount of our commission plus we have to add the $65 onto it. So our amount that we have to pay the broker is $93.78. So what's the total amount that I'm having to pay for the stock? I'm having to pay the $4,360 plus that $93.78 commission. So the total amount that I'm going to hand over to somebody is $4,453.78. All right, so the last couple topics that we're going to talk about are bonds, and we're just going to talk a little bit about it. Bonds are money that you might lend to a company. Savings bonds are a really common example. But a bond is basically you're lending the money to the company, and they're agreeing that they're going to pay you back the full amount of the bond at the end of a certain period of time when it matures. So the amount that they're going to pay you back is what they call the face value. So an example, let's say I have a $5,000 invested in a 10-year corporate bond paying 7.5% annual interest, paid semi-annually. Now, because this is a bond, the semi-annually really doesn't matter because they are not going to accumulate this percentage or this principal or anything like that. So basically, we're just going to do our simple principal times rate times time formula, where the time is 10 years, the rate is 7.5%, and the amount invested is $5,000. And so using that interest, we find out that the amount of interest is $3,750. So that's the total amount of return. That's the total amount that we're going to get back. All right, I hope this helps. Keep in touch with me again. We're at the end of our semester for this work, so let me know if you're having problems, and hope you're ready for your test. Keep in touch with me about that.